Well, hello everyone. So thank you very much for having the paper on the program. So this is joint work with Dmitry Moraviev, who is in the audience here. And so the motivation for this paper stems from the recent evidence documented in the financial press of a massive increase in trading volume around the close. And so that, for instance, as reported by the Financial Times, now the last 30 minutes of trading have an outsized role for US stocks. And so this concentration of volume near the close has raised several questions and concerns, and in particular related to the closing auction, so the very last trade of the day, that there could be, for instance, a glitch. Or in Europe, there is also an increase in volume around the close, and that the concentration of transaction in the closing auction could be a new market risk, and whether also, for instance, if there is any issue with in the US with the primary listing exchange and that it can't run the closing auction, then all hell would basically break loose. So another point of evidence kind of to motivate the potential issues related to the concerns about trading around the close is if you look at what happened last December when Tesla was included in the S&P 500. And so basically this is the price of Tesla over the day. And as you can see, at the very end of the day, there was a very large amount of volatility in the market, and the red dot reflects the closing auction price. And as the difference between the closing auction price and the last price of the day was about 3%. And this 3% surge basically completely reverted overnight. Okay, and so this was associated with a very large trading volume in the auction. And so so in this paper, we motivated by this fact, we try to kind of understand better who trades and why at the close. And so our first finding is that the closing auction volume is strongly associated with passive mutual fund ownership, with ETF ownership, and with institutional rebalancing motives, but we do not find a strong link with active mutual fund ownership, for instance. And then we asked the question, so do prices deviate around the close? So we find that there is kind of closing price is almost always going to deviate from the 4 p.m. midpoint, but on average, these price deviations are going to be relatively small. So despite the very large volume executed at the auction, the price deviation will remain relatively small on average. And so price deviations tends to increase with volume, but we find that in many cases, they are often equal to the half spread. That being said, even when we look at price impact beyond the spread, we find that there is almost no price discovery at the auctions. That is, you see that these price deviations reverse quickly and almost completely. And so this kind of raises the question of, oh, is it possible that there is so much resiliency at the end of the day, given that we see that there is a massive increase in the trading volume at the close, and that at the same time, kind of volume kind of moves prices, the closing auction price away from the last mid quote. And so we argue that one possible explanation for this is that this is consistent with a liquidity begets liquidity effect, that you have other traders that kind of migrate to the close and also provide liquidity around that time. So the auction, we find that the auction matches volume, a large volume at a relatively low cost, but there are two drawbacks. The first one is that we find that this is associated with a decrease actually in liquidity at the open, and we find evidence consistent with an increase in adverse selection, so consistent with theoretical models. And then in some cases, there are large price deviation as in the Tesla case. Okay, so those are the main findings of the paper. So we relate to a large literature on auctions. So most of these papers look at the introduction of auctions. So whereas here, what we are really interested in is in studying this new regime where you have really a record high volume executed at the close. And we are also related to the literature on passive investing and asset prices. Okay, so our sample is going to span 2010 to 2018. So kind of using standard data sets, and we kind of exclude very small stocks. All right, so just to describe, to make sure everyone, we are all on the same page, to describe the end of the day trading process. So in the US, the markets open at 9:30 in the morning, and there is continuous trading until 4. And then right after that, so on average in our sample, this is about 7 seconds after the close, you have the closing auction. And so how does the closing auction work? Well, traders can submit during the day orders that will be executed in the auction, such as market on close order, limit on close orders, and then the order book at the end of the day will also participate in the auction. And the auction price is determined such that the volume executed in the auction is maximized. Okay, and so there are a couple of institutional differences, for instance, between NYSE and NASDAQ, but that's kind of the big picture of how these auctions works. And we have, if you're interested, we have some more details in the appendix of the paper. Okay, so if we look at the fraction of the aggregate volume that's executed around the close, so on the left, it's basically the last 5 minutes of trading. So what we see is that there has been an increase in trading volume in the last 5 minutes, from about 5% to 6%, so a very moderate increase. But if instead you look at the auction itself, you see that there is a the trend is much more pronounced, and there are also spikes, regular spikes. And at the end of the sample period, there are some days where basically 20% of aggregate auction volume, of aggregate daily volume executes in closing auctions. This represents a very large fraction of total aggregate daily volume. Okay, so a couple of statistics. So if we look at kind of the full sample, just the average fraction of the dollar volume for given stocks that's executed in the auction has grown from about 4% in 2010 to more than 7% in 2018. If we look across size groups, what we find is that the fraction of daily volume executed in auctions is about the same between small and large stocks. So it's a little bit higher for small stocks, but the key difference is that there are actually many more days without an auction for small stocks. So even though we kind of expect from theory that these auctions maybe make more sense for small stocks for which adverse selection is more of a concern, and so here the auction would make more sense because you would pool the trades and reduce the adverse selection issues. It looks like that for the auction to work, you need kind of a minimum amount of trading volume. All right, so let's move to our one of our first main specification in which we are trying to understand what drives volume around the close. And so the dependent variable are going to be log auction turnover, the last 5-minute turnover, and then as a comparison on the right column just shows the intraday turnover. Okay, and I'm mostly going to be talking about the auction turnover and the last 5-minute turnover. And what's important to emphasize is that here we are controlling for intraday turnover. So really this is going to look at the effect of these variables beyond what is predicted by intraday turnover. And so the first set of variables that I would like to talk about are related to institutional ownership. So we first find that there is a strong positive association between passive mutual fund ownership and the auction volume, whereas it's much weaker when you look at the last 5 minutes or at intraday turnover itself. And so this is kind of consistent with this idea that a lot of passive investors are going to use the auction, are going to trade in the auction because they would like to minimize tracking error. So given that a lot of benchmarks and indices are set based on closing prices, the only way, one of the way for you to basically have a zero tracking error is to trade in the auction. So if you look at active mutual fund ownership, in contrast, you don't find any effect. This elasticity is zero. So what's also interesting is that there is a very strong association between ETF ownership and the auction turnover. And again, it's much higher in the auction than, for instance, in the last 5 minutes. And so it's a little bit more difficult to explain than the effect of passive mutual fund ownership, because we know that ETFs do not necessarily have to rebalance their portfolio at the close. So potential explanations would be that leveraged ETF, so they would need the leveraged ETF need to rebalance their leverage at the end of the day, and the arbitrage activity would translate into higher volume for the underlying stocks. It could also be that some ETF arbitrageurs use the auction kind of to complete their trades at the end of the day. Or finally, it's also possible, and perhaps that's what's going on, that ETF ownership is proxying for something else, for the fact that other traders who tend to be also ETF investors tend to move their volume towards the close. If we look at variables that are associated with institutional rebalancing, we find that, as expected, there is a very strong increase in auction volume on Russell rebalancing days, on option expiration days, and also on the first and last day of the month. If we look at a proxy for informational events, such as the days around earnings announcement, you see that there is a pretty strong effect for turnover in the last 5 minutes, but there is not much going on for the auction beyond what is predicted by intraday turnover. So it does not appear that you see abnormal turnover at the auction on this day, whereas that's the case for turnover in the last 5 minutes of trading. Okay, so just again to emphasize a little bit this difference between the different types of ownership and their relation to the sensitivity of volume relative to these ownerships. So this just shows you these elasticities over the last 30 minutes of the day in 5 minutes interval. And as you can see, there is not much of a difference up until the last 5 minutes of trading. And then you have this marked divergence for the auction, where active mutual fund ownership is not associated with auction volume, whereas passive and ETF ownership are strongly associated with auction volume. All right, so let's move to price deviations at the close. And so our main measure of price deviation is going to be the absolute value of basically the return between the last mid quote at 4 p.m. and the closing price. And so what we find, the main result here is that this deviation is about 8 basis points, okay, which is relatively small. So this is about $6 million for the average stocks in our sample. That being said, in 5% of cases, these deviations can be greater than 26 basis points, and in 1% of cases, they are greater than 60 basis points. So there are cases where you can have large price deviations right at the close. And they tend to be larger for small stocks. We also find that they tend to be correlated, and that this kind of common component jumps on days where, for instance, institutional investors have to readjust their portfolio. So again, this kind of supports the idea that indexing is important for closing auction volume. We can decompose this deviation into a half spread component and a price impact component. And here this shows you the price impact in basis points. And you can see that it's very small. So it's about only half a basis point. So this shows that actually the largest fraction of these deviations, of the average deviation, is due to the half spread. Okay, so this accounts for the bulk of the price deviation. And actually that for 76% of auctions, of all auctions in our sample period, the price impact, so beyond the half spread, is either 0 or negative. So many auctions are going to execute at the half spread or better. Okay, so here's another way to look at this. So this is a histogram of the auction absolute dollar deviation divided by the half spread. And as you can see, there is a large concentration of auctions, about 70%, where the deviation basically is equal to the half spread. Okay, so why is it the case? Well, we find that actually a large part of that is because the tick size is binding at the auction, because bid-ask spreads tend to be very narrow at the close, around the close, and so the binding tick size explains why a large fraction of this deviation is actually just equal to the half spread. Okay, so what are the drivers of price impact? So still there are in about a quarter of all price deviations have price impact. And so we find that the higher the auction turnover, the higher the price impact at the auction. There is a negative relation between intraday turnover and price impact. And one potential explanation for that is that when intraday turnover is high, there is just improved liquidity. And we also find a strong relation between realized volatility and price impact at the auction. And finally, there is this interesting that even when you control for all of these other factors, NYSE auction tend to have always larger deviation than NASDAQ auction. And this is consistent with the evidence in in the paper by Edwin and Dermot about the lack of transparency on the NYC on the NYC auctions. Okay, so is the price noisier at the auction? And so one way to look at that basically is to regress the overnight return from the auction till 9:45 on the next day on the signed auction price deviation, so the return between 4 p.m. and the auction. And basically, if there is, it contributes to price discovery, this B coefficient should be 0, whereas if there is complete reversal, it should be equal to -1. Okay, so since we know that many of these auctions trade at the half spread, we kind of expect there to be some bid-ask bounce. So here I'm just going to focus on the second column where we look only at the price impact. So that is, we look at the return that's adjusted for the bid-ask bounce. And what we find is that pretty much there is complete reversal. So we don't find any price discovery at the auction, or very small. It's not exactly -1, but it's very close to -1. And this reversal is much larger than, for instance, the reversal you observe, for instance, between 3:55 and 4 p.m. Okay, so there is very strong reversal. And also what's interesting, so what are the explanations for this reversal? So one explanation is that basically you have price pressure at the close, so kind of liquidity provider require a discount to absorb the liquidity shock at the auction. And then there is reversal overnight that's going to compensate you for bearing overnight risk. And so I think this explains part of it, but what's also interesting to see is that about 1/3 to 1/2 of the reversal occurs right after the auction. So when we look at large stocks for which we have trades after hour trades, which there is enough volume after hours, what we see is that actually roughly half of the reversal, between 1/3 and 1/2 of the reversal, is already occurs right after the auction. And anecdotally, if you go back to the Tesla example I gave you at the beginning, this is also what happened for Tesla. Pretty much half of the reversal took place right after the auction. So it suggests perhaps some kind of segmentation right at the auction. Okay, so I'm going to skip that, but we look at other measures of price discovery and we find similar results. Okay, so now let me talk a little bit about how do these price deviations vary over time. Okay, so this just shows you the average price deviation for small stocks and large stocks over our sample period. And you can see that for large stocks, actually, there is a downward trend in the price deviation at the auction, whereas for small stocks, it's relatively flat over the sample period. And here you see that there is a large increase in the price deviation for small stocks. And basically, this is the introduction of the tick size pilot program by the SEC. And because the spread is so important for the auction price deviation, that's exactly when we see a large increase in the price deviation at the close. Okay, so when we see this picture, it kind of raises a little bit of a puzzle in the sense that we know that auction volume has increased massively over our sample period. At the same time, we find evidence that for a single stock, when there is high volume at the auction, there tends to be high deviation. So volume is kind of pushing the price away from the midpoint at 4 p.m. But at the same time, if you look at this picture, kind of these deviations have either been flat or declining. So what can explain basically this trend, this kind of conflicting trends? And so one possible explanation for this is kind of a liquidity begets liquidity effect. And this is the idea that some other traders we see that you have more passive investors who are shifting their trades to the close, then these other traders also decide to shift their trades to the close and provide liquidity at that time. And so this is going to explain why the rise of passive investing cannot fully account for the trend in closing volume. Just the magnitude is too large relative to the change in the amount of passive investing. And this is also going to make predictions based on models such as AdMultiplier or Foster and Viswanathan that you should also observe specific patterns for liquidity during the rest of the day, and in particular that liquidity should worsen intraday. And so in the last part of the paper, this is what we are checking, what we are looking at. And so we focus on the first 15 minutes of trading. And we are going to only look at very large stocks for which we have that are traded over the full sample period. And so we are going to run very simple panel regression with stock fixed effect, control variables such as size, volatility, and volume. And then we are going to look at ER fixed effects. So there is really, I want to be upfront here, is we are just looking at trends. We are not having any, cannot make any causal claims. And so we are going to look at all these different variables change over the sample period and whether this is kind of consistent with this liquidity begets liquidity effect. So first, if you just look again at the volume itself, there is this increase in auction turnover. And at the same time, we see that if you look at turnover earlier during the day, there is a pretty large decline in intraday turnover. Okay, so it's in raw turnover around the open. If you look at liquidity, at the open, spreads went up by about 10 basis points for this stock. So this is, in my view, this is a pretty large increase in spreads for large stocks. And you see also a substantial decrease in depth at the best prices, so about 60%. What about price discovery? So is it associated with higher price discovery? Return autocorrelation kind of give not really any significant pattern, but if you look at weighted price contribution, we find that there has generally been an increase in adverse selection at the open. So again, consistent with this theoretical model. So, and consistent with the fact that some traders shift their trades to the close. Okay, so let me conclude. So to conclude, we think that this closing auction is likely to become even more important with the expansion of passive investing. And this represents one way in which passive investing affects asset prices, but not only at the end of the day, but also liquidity and early during the day. We find that the closing volume is strongly associated with with passive ownership and institutional rebalancing. There appears to be efficient kind of quantity discovery at the auction, though in some cases, such as in the case of Tesla, closing price deviation can be really significant. And you also have a negative effect on intraday liquidity, and in particular at the open, which may be of concern if this kind of increases fragility at the open. All right, thank you very much.
Thank you very much, Vincent, for the presentation. Discussant is Barbara Rindy from Bocconi University. Please go ahead.
Can you see my screen?
Yes.
Yeah.
Thank you so much for inviting me discussing this interesting paper. I really enjoyed reading it. So what are the main research questions and results of this paper? Did the closing auction volume share increased over time? And the answer is yes, because it went from 4.13% in 2010, almost doubled in 2018, reaching 7.27%. Who trades at the close? The paper convincingly shows that ETF and passive mutual funds trade at the closing to minimize tracking error, which makes a lot of sense, while active mutual funds do not necessarily trade at the close. I didn't find convincing evidence about what informed traders do. All what we can say is that on earning announcement days, auction volume does not significantly change given the controls. And then there are two other important questions which the paper raises. And one is, does the increase in closing auction volume distort closing auction price? And the other one is, does the shift in trading towards the close affect intraday liquidity and price discovery? And these are the 2 points in which I would concentrate the rest of my discussion. So let's start with the dislocation and start with descriptive statistics. The deviation with dislocation, which you measure as the difference between closing auction price and the price at 4 p.m. in the continuous auction, on average is 8 basis points. And there is a huge difference between small stocks and large stocks. Small stocks have 20.6 basis points, large stocks less than 3 basis points. And when you rightly split this deviation into two components, one which is due to the bidder's bounce, half spread, and one which is the price impact, you find that the half spread is on average across all stocks at 7.56 basis points, whereas the price impact is half a basis point. And again, there is a lot of difference between small stocks and large stocks. On your table 4 of the descriptive statistics, you show that you have positive skewness in the distribution of auction price deviation. So the closing auction price is generally close to the mid, but occasionally it diverges substantially. So maybe we wanted to look at the median value for the same deviation aside of the mean value. And if you look at the median, the numbers are different in the sense that we have 4 basis point median deviation, more reasonably split between small stock and large stock, 12.35 against 1.36. And when you split the deviation into half spread and and price impact, you have 3.3 basis point on average and almost zero price impact. And again, the split between small and large for the half spread is reasonable, and the price impact between small and large spread is still about 0 for for both small and large stocks. So my takeaway from this first look of descriptive statistics is that there are deviations, and these deviations are due to some extreme observation. In the paper, you nicely also show that 64% of deviation takes place at one tick. So basically it's going, so there is no price impact for these 64, and then you have 42 out of 64, 68 is deviation with binding tick size, meaning that they're probably associated with large stocks, and so only 24% of all of auction execute with price impact. So we're talking about these price impact down here. Also, you show that price deviation for both large and small stocks decline over time, and the deviation for large stocks is more substantial. The decline and the deviation over large stocks is more substantial. It's less substantial than one for small stocks. The break point here is due, as you said, to the US tick size pilot, in which we had the tick size increased by 5 times for small stocks, and because it increased by 5 times, it also increased the minimum spread by 5 times, which is part of the deviation. So this is why there is this break-even point here, which has nothing to do with the closing auction. This is also important because when you regress the auction price deviation on your control, maybe you want to consider to add a dummy for the US tick size pilot, and also maybe you want to consider to add a dummy for the rebalancing days. You find that the auction volume as a proxy for imbalance is positively related, which is intuitively correct, with the auction price deviation. Maybe, I don't know whether the data is available to you, you can use imbalance directly here. Also, you were puzzled about this intraday turnover being negatively related with price impact. Maybe intraday turnover is negatively correlated with beta spread, which might affect the sign and the size of this coefficient. So you might want to consider removing either intraday turnover or beta spread from this regression. And finally, you interestingly find that NYSE auctions have larger deviation than NASDAQ. And this is consistent with Hu and Murphy 2020, which find that the NASDAQ is less, the NYSE protocol, closing protocol is less efficient than the NASDAQ closing protocol. So again, to update my takeaway, deviation are due to some extreme observations, and maybe due to small stocks, maybe due to stocks which are traded at the New York Stock Exchange. Also, it is important to consider, as you did, the reversal. So how much of this deviation is reversed the next day? And when you measure this deviation by considering the closing auction price, so you regress the overnight return on the deviation between the closing auction price and the 4 p.m. price, you find that the reversal is really substantial, minus 0.85. Whereas when you substitute the closing auction price with the price at 4 p.m. in the continuous auction, this reversal is about minus 0.19. So again, updating my takeaway, deviation are due to some extreme observation, almost completely reversed the next morning, maybe due to illiquid stocks, maybe due to stocks which are traded at the NYSE. So my next comment deals with this question: why the NYSE results may affect the overall outcome. And here I reported the protocol of the NASDAQ and the NYSE as it was during your sample period, and below the protocol of NASDAQ and NYSE as it is today. So what I did is consider a case of a positive imbalance in which you have that for the reference price is the NASDAQ ask price, which is the price which clears imbalance on the continuous auction, whereas the price which cleared imbalance on the closing auction, the FAR price, is over the NASDAQ because we have a positive imbalance in this case. So what happens in the NASDAQ? Up to 350, you can post order of any direction, but when the bell at 350 rings, then you cannot cancel or modify your order, and you cannot post order if not offsetting the imbalance which has been publicized. So there is an implicit kind of convergence mechanism in the NASDAQ, which should in theory guarantee that the closing auction price, which pulled together the FAR price and the reference price, should not differ substantially from these two prices. Now, how does this mechanism work for the NYSE? NYSE rings a bell at 3:45, 5 minutes earlier, and at 3:45 you cannot cancel or modify your orders any longer, and you can only post orders which are offsetting the imbalance, also opposite sign as the imbalance. However, there is a very important difference here between these two protocols. And what is this difference? The difference is that investors may actually effectively submit orders which are not offsetting and go in the same direction as the imbalance if they trade via the designated market makers. So I designed this line dashed here, but it could go anywhere. Interestingly, at 3:55, this imbalance of the designated market maker's order is made public. And therefore, everyone can see what is the designated market maker orders. And this new bell, which is 3:55, is important because today, after October 2018 and January 2019 for the NYSE, both protocols move the system forward by 5 minutes. So now the bell, rather than ringing at 3:50 at the NASDAQ, it now rings at 3:55. Interestingly, exactly when the DMM orders are made up public on the New York Stock Exchange. And similarly, the New York Stock Exchange moved forward the bell by 5 minutes. So this is just to say two things. First, the NASDAQ and the NYSE have a closing protocol which differs in a very substantial way in terms of convergence. And therefore, we should keep the two separated. And second, that those 5 minutes, which actually is basically the closing cross for the NASDAQ and half of at least of the closing cross for the New York Stock Exchange, is really important. This is just to say that when you compute your average weighted price contribution, you might want to consider to, rather than collapsing data by 5 minutes, dig a little bit more into these 5 minutes and separate these, divide this interval into even 10 half a minute interval, if the data, of course, allows you to do so. So all in all, my comment on the dislocation results. So maybe you want, as I said, to consider the idea of split the sample into NASDAQ and NYSE platforms, and also split each platform into NASDAQ listed stock and NYSE listed stock. This is in order to have a better picture of what's going on. Also, as I said, you might want to consider splitting that interesting period, which is 555 up to 4, into small intervals, as I said, depending on what the data allow you to do. And finally, maybe you want to consider not to Winsorize the data when you do this exercise of measuring the average weighted price contribution of the weighted price contribution of NYSE versus NASDAQ, in order to be consistent with the data you present in table 4. Now, what is the last question which you answer in this paper? Very important and interesting question. Now, does the move of the closing auction volume towards the close affect in any way intraday liquidity? And you consider here the intraday period of 15 minutes of trading in the morning. The first 15 minutes of trading from 9:30 until 9:45. Also, you restrict your sample to large stocks. I was just wondering, maybe you want to consider to do it also for small stocks. I think it would be very interesting, especially when you talk about fragility, adverse selection cost, and so forth. Also, my second comment on these results, this set of results, is that maybe you should consider to relate your results, which come from these panel regression, and which produce these interesting plots, to the closing auction volume. So these plots that you present here intuitively makes a lot of sense. Open turnover goes down, when auction turnover goes up, effective spread seems to deteriorate, depth seems to deteriorate. But again, there is nothing which tells me that these plots and that these dynamic are related to closing auction volume. So all in all, my takeaway is the following, my conclusion. You are tackling a very important research question, which is the US closing protocol efficient? In terms of dislocation, there seems to be the dislocation seems to be related to some extreme observation. So this is why I suggested that you might want to consider separating NYSE and NASDAQ market and listing. And the reason is that I would like to emphasize these two have a different protocol, especially when talking about dislocation. And this might also allow us to understand which of the two systems has a better price discovery, and also, even more importantly, whether we need a different closing protocol when we talk about large liquid stocks versus small illiquid stocks. In terms of your regression on dislocation determinant, you might want to consider adding a dummy for the US tick size pylon, and also a dummy for the rebalance days, see Tesla, for example, and then remove, if you want, the intraday turnover. And finally, on the market quality metric, as I said, I think you should try to address the issue of endogeneity. And this is really important, especially when you want to draw conclusion about market fragility at the opening. So this is all on my side. Thank you very much for giving me the opportunity to read and think about this very interesting paper.